Okay, students. So today what we are going to discuss is, how secured loans are given by the banks to the customers, whether it is commercial lending or consumer lending. There is a standard of, creating secured advances, secured lendings by the banking institution. So we will study today what are those. So already in the method of financing or method of granting advances, we have studied what type of loans are there, right? Short term and long term loans, what is short term financing and long term financing, the benefits, the disadvantages of each of the category we have discussed in detail, including, the short term advances like cash credit, overdraft, discounting of bills. Now, the secured advances, which are usually for a longer term, we have discussed in the previous class that there are, some of the loans which are granted for a period of 5 years, 7 years, or 10 years, which are considered as long-term financing options. So when banks usually lend or grant loans for a longer period of time, they would like to secure the lending process. So when they would like to secure the lending process, they would also like to bring into emphasis one of the sound lending principles of safety and security. So when you are giving loan to a consumer or a commercial organization, you need to make sure that you get the money back, the advance that you have offered to the customer, that needs to come back, right? Because of the good financial health of the banking organization, or for the future of the banking organization, for the purpose of earning profits, increasing revenues, distributing those revenues and profits to the stakeholders, interested parties in the business, etc. Right? To have a good financial health, secured advance is one of the good equipments for the bank to use when they are in the process of commercial or consumer lending. So what they do is they basically secure uh, a personal security or a personal asset or a guarantee against the advance that they have given to the organization or the consumer or the individual. The basic objective of obtaining securities is to recover the unpaid amount of loan, if any, through the sale of these securities. So the purpose with which the bank would like to secure the loan is take either the property or security, or any kind of guarantee from the consumer or the organization, to make sure that the person pays back full amount. Otherwise, the remaining unpaid amount of the loan plus interest will be taken from the sale of, or the proceeds of the sale of the asset or security that has been kept with them. So what happens, what type of securities, what type of assets can be taken as a security by the bank when giving secured advances? One is that the personal securities, which are intangible in nature. So for example, promissory notes, bills of exchange, security bonds, personal liability of a guarantor, right? These kind of things that you possess. You have some securities, investments, stock, etc. The second type of category is tangible securities such as land, building, machinery, etc. Third is primary securities. These are the securities which are created with the help of finance made available by the bank. So for example, I have taken a 10 years loan as a commercial organization from one of the banks, and I have bought a factory using that loan. Now, that factory becomes the primary security for the bank. The papers of the contract of the loan agreement will be signed in such a manner that this factory will become a kind of security for the loan that has been given for 10 years. If the person pays back full amount of the loan principal and interest by the end of 10 years, then probably he does not have to do anything with the security. The bank will release this primary security. But in case some part of it or most part of it or 100% loan principal plus interest is not paid by the commercial organization, then bank has a right to forfeit the primary security and sell it off in the market to gain proceeds and repay the debt in that way. Collateral security. So security, if you look at this, security is not the security that is financed by the bank. It is the additional security given by the borrower, where the primary security is not enough to recover the loan amount. So basically, collateral security is a kind of double security. So for example, you have taken a loan of 10 crores as a commercial organization. You bought a factory of 5 crores, 6 crores, or maybe, it is estimated that after 10 years, uh, the charge on the factory created would not be 10 crores. So what you do is you give your personal security, tangible security, or some other security that you have kept with you as land, building, to complete the value of 10 crores loan. Because when you are getting 10 crores plus interest amount of advance from the bank, obviously the security amount should be equivalent. So that is what is collateral security. So basically, if the primary security is not able to cover the value of the advance given by the bank, then the collateral would cover that remaining portion up. That's what is collateral security. Now, once these securities are put into the agreement of the loan, then some charges are created. So in the case of secured loan, when the security, personal security, primary security, tangible or collateral security has been put in by the customer to the bank for the loan, a charge is created on the asset in favor of the bank. So basically it's an agreement in which bank creates a charge on the asset, and that charge states basically that bank has a legal right to get the payment in case the customer defaults the loan amount. Some part of it, full, half, whatever that is. To recover that remaining portion or unpaid portion of the loan or advance, this security will be charged. And that's why this is called creating the charge on an asset, where bank obtains a legal right to use the asset to get the payment of the loan amount. But please bear in mind that this happens only when the institution, the institution which has taken the loan, which has taken the advance, is not able to pay back the amount. That is very, very important. So only the charge will be used, only the charge related legal right will be exercised when the bank is not able to recover the loan fully or partially. So depending on different types of legal provisions regarding charges, there are different types of charges that are explained. So the first one is lien. Lien gives the right to the banker or the creditor who has given the advance to retain the goods and securities owned by the debtor, or to whom the loan has been given, until the entire amount of the debt is paid back. Now, the most important thing is that you can retain the goods, retain the stock, retain the security given by the borrower until the entire amount of the loan is paid back along with interest. However, the banking institution, the financial institution, doesn't have a right to sell the assets to take the amount. This is the first type of charge that is created. The security is given to the bank on legal right of the bank to retain the security, retain the property, not having a right to sell it off to gain that. Right? The second one is, so lien has some details, some features are given in the below paragraph for the lien that you can go through and let me know if there are any questions. The second type of thing is the pledge. Pledge is a bailment of goods. Bailment of goods, you must have studied bailment contract between the borrower and the bank in the first year, when you must have studied the mercantile laws. So what happens? The pledge is given as a security for payment of debt or performance of a promise. When the borrower secures a loan through a pledge, he's called a pawner or the pledger, and the bank is called pawnee or the pledgee. Bank has received the security of the asset, right? And the borrower has given the pledge, so he's the pledger, right? So goods, property, securities can be pledged by the owner or the joint owner with the consent of others, right? The banker can retain the goods for the payment of the debt for any interest that has accrued on it as well. Now that's the first difference between lien and pledge. Lien is only for the value, principal amount of money that has been given in advance by the bank. But here, it covers both principal amount as well as interest, and any expenses incurred by him for keeping the goods safe and secure. Now, bank would keep those as a legal right, will keep those assets, will keep those properties or goods for a longer period of time with them, and they may have to maintain those things as well. So whatever expenditure bank will perform, bank will incur on maintaining of those assets, etc., that expenditure can also be included as part of the pledge. The goods retained are kept for the loan that has been taken and in which the security has been kept as a pledge, not for any other security, not for any other loan. Say, for example, I have taken a loan, I have pledged my land and building, for example. The loan that I have taken on which I have given the pledged property will be used for that only. In case of non-payment, banker has a right to sell the goods and recover the amount of loan along with interest and expenses. That's the difference between lien and pledge. Third is hypothecation. It is a very popular model you can see in consumer lending field where, house loans and home loans and vehicle loans and two-wheeler loans are given. This is one of the best examples of hypothecation. So it's an extended idea of pledge. It's a kind of pledge, but an extended pledge, whereby creditor permits the debtor whereby debtor retains the possession of the goods. He starts using those goods on a higher basis. And then a charge is made on the movable property in favor of a secured creditor without delivery or possession. The charge is created only on movable goods like stocks, machinery, vehicles, etc. Now, the most important thing is when you look at vehicle loans, etc., hypothecation is done on that particular vehicle that has been bought. This is also one example of primary security that has been created. You have taken a loan to buy a new house. That house becomes your security for that loan, right? But the point is that bank doesn't have the possession, but has a legal right to forfeit the house. So they have to initiate the process of legal process to forfeit the house, forfeit the vehicle which has been kept in security for non-payment of the debt. And once they have taken the possession legally, then they can sell the property off and get the payment for the debt. So that is what is hypothecation. Now comes assignment. Assignment is also a type of contract in which the contractual rights and liabilities are assigned to a third party. You have a property against which you have rights and liabilities. You will contractually transfer that as an assignment to the bank. So the person who is the borrower is called transferor, and the bank who is receiving the contractual rights and liabilities of the property, it is called assignee. The borrower can assign any of his rights, properties, or debts to the banker as security for loan. These might be for existing or future loans. So assignment has a broader concept. I want to take, say, for example, 1, 2, 3 loans in next 10 years. So I have, assigned my rights, my liabilities, my debts to someone else. My debts are the loans that I have given to someone. I have to recover the debtors I have assigned to him. That go ahead and take payment from them in case I have not been able to repay the amount of loan that I have taken. And again, it's a broader concept. I can take some amount of loan from one time to another time, some amount of loan some other time, and that is covered by this assignment. So this is one more example of creating the charge on the assets or properties for secured advancement. Mortgage, where a customer basically secures an advance on the security of specific immovable properties to charge. That is called mortgage. Mortgage is associated with immovable property like land, building, etc., factory. It would not be on movable properties like vehicles, etc. So it is covered by Transfer of Property Act 1882. It tells you what is mortgage, who is a mortgager, and who is a mortgagee. Mortgagee is basically the bank which is receiving the the security, and the person who is giving the security as a pecuniary liability, that person is called transferor or mortgager. So there are different types of mortgages: simple mortgages, usufructuary mortgages, equitable and legal mortgages, etc., etc. So that you can go through in detail and understand what those mortgages are. So these are when a secured lending happens, when a bank goes ahead and gives a secured advance to a customer, whether customer, individual customer, or a wholesale customer, or a bank or a commercial organization. It creates a charge on assets and properties. What are those assets and properties? We have studied those types of assets and properties on which charge is created. What are those different charges? Lien, mortgage, assignment, hypothecation. This is what we have studied, that there are different types of charges which are created, and every type of charge has its own features and characteristics, and some of them are extension of one another. Like, for example, hypothecation is an extension of pledge. It includes the features of pledge, but it has some extension to it. And then the last portion of unit 2, which is the bank loan for export business. Now, the very important thing is that, Government of India, through different types of schemes, promotions, and activities, would like to promote India's contribution in the global market of manufacturing. Because India has a wide country. India has second largest population in the world. India has density of population. India has places and opportunities for investment. India has decent skill set. India is a young country. Considering all these things, government would like to promote and bring forward the export business of the country. That whatever talent and skill you have in the country, you use that for the purpose of manufacturing. You manufacture products and services of world class at the global level and get it exported to other countries, so that Government of India and these companies would be able to earn revenue in foreign currency, which would obviously increase the levels of foreign exchange in the country. Increase in the foreign exchange would give a financial strength to countries' economic conditions. And there are other economic impacts like raising the standard of living, national income is increased, you have a better balance of payment, balance of trade history with other countries, etc. Right now, the situation is that you import more than your export. You import more amount of products, so you spend more amount of money on imports than earning amount of money on export business. So what happens is there is a standard that if you want to start an export business, what you need to do, you need to establish a private company or a legal liability company, obtain necessary tax registrations like 10 GSTN service tax, which is called goods and services tax, right? And you also need to get export license, right? If you want to import, you need to follow what is there in the import export code, right? These are the things that you need to do when you start the export business. Also, for initiating export business, if you're lacking finance, you can go to the bank, right? And take the finance. The most important thing is when you go for an export business, it is most important to have a bank account, because these days when you go for tax registration in the network, you need to have a bank account mentioned over there as well. These are primary requirements where export business is being considered. What types of loans are given for the export business? One is that you are starting an export business, you are going to diversify an export business, you are going to expand export business, right? Or you want to add some imports into your export business. These are the areas where loans are granted. And what type of loans are given? Term loans and working capital loans. Term loans are simply 3 to 5 to 10 years for export growth and promotion. Working capital is basically for financing your less than 1 year needs like salaries, wages, taxes, etc. The working capital is given to you. So bank finances your very short-term loans like short-term advances, overdraft, discounting of bills, etc. Also, what happens in the export business is that some of the things are very, very important. So when you are going for packaging or pre-shipment, so you have produced the product, you now want to pack it, you want to make it an interesting package, right? You don't have money for packaging purpose. You can go to the bank associated with export promotion, right, and get the packaging loan. Or you want to transport products from one place to another. This is the first time you're doing it, or you do not have sufficient money in your pocket to transport products to the shipment area. What would you do? You would like to take a pre-shipment credit or a packing credit, right? Similarly, post-shipment loans. So post-shipment loans are sanctioned for an exporter from the date of shipment of goods to the date of realization of payments. Now, for what happens is, it's in the scenario of exports, it's slightly a different kind of scenario. You receive an advance from the importer when you are an exporter in India. You start making products and services. When you start producing and manufacturing products and services, at that time also you may need some kind of working capital loan to be able to manage the entire order. For example, the order is 50 lakhs. You have received 5 lakhs advance. They say 45 lakhs will pay at the time of delivery. So if you are starting to manufacture products, you are a small scale or a mid-scale organization, you may not have 45 lakhs to finance your order, because you have to call the workers, labor, employees, maintenance of office, electricity bills, tax, charges, this, that. So you may have to go to the bank to take the working capital loan. That is what is pre-shipment credit or a packing credit. Post-shipment is that once you have delivered the product, it has been shipped from India to, say, for example, Israel. It will go via ship or by plane, land over there, will get investigated at the customs level, will be released by the customs. It will reach the businessmen. It may take 10, 15, 20 in 1 month. For example, during this time, the person has already delivered an order of 50 lakhs, plus he has spent some money of 10, 15 lakhs, say 75 lakhs expenditure has been done. And he has got only one advance of 5 lakhs initially. So bank may extend some short-term credit to be able to manage more orders, to be able to run the factory completely. Once you will receive the full payment of 50, 55 lakhs, whatever that amount is, then you can just go ahead and repay the post-shipment loans if offered any, or the packaging or pre-shipment credit that has been offered by the bank. So in both the cases, you can see this is a kind of working capital loan. Export credit refinancing. So RBI is basically, providing this export credit refinancing facility to the banks on the basis of banks' eligibility for outstanding rupee export credit for both pre-shipment and post-shipment. Banks can extend a loan up to 15% of the outstanding export credit eligible for refinance. And the condition is that within 6 months, you have to repay the entire refinancing amount, and there is no collateral required. So basically, there is no security required for this purpose. Collateral security required. So these are the different steps. So working capital, pre-shipment, post-shipment, export credit refinancing. These are the short-term and long-term loans that are offered by banks, supported by RBI for credit export promotion, growth of export in the country, growth of manufacturing in the country, growth of skills in the country. And we all are aware that government is vehemently proposing and promoting Make in India scheme, where they're calling for even foreign companies to come to India, establish their plants, and start working on manufacturing and export from here. You come here, manufacture here, and sell outside. Give employment to our people. Give a chance, an opportunity to our people to show their skills and go ahead, being the youngest country in the world. So this is what is bank loan for export business. So this is where your unit 2 gets over. If you have any questions on unit 2 related to how employment of funds happen for loans, types of loans, profitability, liquidity, long-term financing, short-term financing, right? Types of secured loans, types of charges created on securities, properties, and bank loan for export business, please let me know. And this is the last lecture. Please complete your assignments on time. Thank you.